Welcome back to a special Christmas Eve edition of the Bloomberg Asia podcast. I'm Doug Krisner. So with 2024 pretty much in the rearview mirror, we want to look ahead at the major themes likely to drive market action in the year ahead. I'm pleased to welcome Rebecca Walser. She is president of Walser Wealth Management, joining us here in our studios in New York City. Nice of you to drop by.
Love being with you, Doug. Thank you for having me.
Thank you. I'm looking forward to this conversation. What do you think the new year is going to hold when Mr. Trump takes office and we start to get greater clarity on some of these economic policies?
So we've seen a really big divergence with CEOs and CFOs specifically really having a positive economic outlook globally under the new administration in comparison to the previous I'd say 2 decades. Like there's really big positive economic momentum that they feel with this Trump administration is going to be possible. I don't know, Doug, if it's related to his tariff policy, the fact that he's been so open and blatant about it, that he's already having world leaders discuss that. We're already having Europe say, hey, we're going to buy crude from America instead of Russia. We've got a lot of moving parts. So there's a lot of positivity, which is really great, which is why, too, Doug, that you saw the Fed literally at the last FOMC meeting come back and say, hey, we're going to pare down the expectations from really more than three or more to 2 or really 2. And when you consider that they started saying 2024, we're going to have 6 and we're only going to have 3, then you can see that they already kind of backed themselves into a corner. And I think they learned a hard lesson. Yeah,
I think you're right about that, because even Powell said that there were members of the FOMC, the Fed's committee that guides interest rate policy. They expressed some uncertainty about where disinflation may be going from here, and largely because of exactly what you're talking about, the incoming Trump administration. Yeah. And it's not just tariff policy, is it? I mean, it's a bit of spending and also the possibility that
investment.
Well, tax cuts too could be a drag.
Tax cuts too. Well, I mean, I'm not really happy that the political clout is not there to work on the tax extension of his jobs and tax cut of 17 at the beginning of the term, because literally they're talking about we're going to do border stuff, we want to do these things first, and then we'll look at the tax policy. But we know that the tax jobs cuts act is sunsetting at the end of 2025, beginning of 26. So we really need the political clout to go after that pretty quickly. So I'm a little concerned that they're kind of pushing that more to the back burner later in the year instead of doing it right up front when they have the mandate, because you know how politics get in the way and things change. And then if we get some kind of bad economy where we need more stimulus, and I do think that is a really big risk. You know, Doug, I've been saying that there's a lot of hopeism and there's a lot of irrational exuberance on the AI sector. I believe AI has got a long runway and it will deliver just like the internet did in the 2000, but we still had to go through the dot-com crash before we realized how to monetize. So that's why I'm saying AI is gonna bring us real, true results long term, but to expect that we're going to keep this 20 plus growth rate before the monetization happens is not right, and that's more comparable to dot-com.
You know, it's interesting that you make that point, because when the Fed made its decision, I saw how hard hit small cap stocks
Absolutely.
were, right? And so you think that's going to be a big question mark over some of the companies that are more exposed to the domestic economy and not so much kind of exposed to what's happening internationally?
I think yes, absolutely. But I also am, as you know, I've been very bearish on global economic situations, both in Asia and Europe, because these theaters have been really experiencing economic malaise a lot longer than we have. And I would say, we had 2022 that was obviously a problem, right? But this year, hey, we've run this AI wave, and yet that's not what Germany's experiencing. That's not the EU's experiencing. That's what the UK's experiencing. That's what China's experiencing. We have big problems. They just haven't arrived here yet. So while we have Trump and we have all this positive economic outlook, and I love that hopeism, I just see the reality. And I also do see, Doug, that we had a lot of influences trying to really sort of help look at the numbers from a recession basis. We had a lot of things triggered that said, hey, we are already in recession, yet all of the official administrative reports were, no, we're fine. And now that we have this Trump administration coming in, I'm wondering if we'll see a sea change in the data and start saying, okay, yeah, there is some issues here.
So you're looking out ahead, and I'm interested in knowing how your investment strategy is changing for 2025. What are you doing differently?
We have to broaden out. We've been really commodities focused because we really did feel that we were going to have some kind of retrenchment and pullback, and that it was too much optimism too fast on the AI AI sector. I also have a little bit of a concern, honestly, Doug, when I have U.S. officials, President Trump included, Senator Loomis introducing a Bitcoin bill about a Bitcoin Reserve Act in July of 24. And what you're talking about is now creating a Federal Reserve funded by the Federal Reserve that is in Bitcoin. We're talking about 1 million Bitcoins is the proposal for the Bitcoin Act of 24 that Loomis proposed. And when you're looking at that, Doug, what are you really saying? You're saying, we are the global reserve currency of the world since Bretton Woods. That has not changed yet. We are acknowledging, admitting, and then actually taking action to maybe look at an alternative to be a reserve currency. And that says a lot. And I think that people are skipping over that, not even realizing, well, why can't we hold the reserves in dollars? And there's that competition isn't happening, and that's a big problem.
What about changes in the regulatory regime that the Trump administration may initiate? Banks?
I mean, very pro-business, very pro-crypto. I mean, look at Gary Gensler. Obviously,
right.
A lot of origination of litigation. And so, yeah, I think that will be very much more pro-growth on that side.
We've seen how the financials have benefited,
yes,
right? Maybe
yes.
we get fewer regulations where banks are concerned. But I'm wondering about the M&A environment. Are you expecting a lot more deal making in the new year?
I am. But again, deal making from an administrative policy perspective, yes, let's cut red tape, let's make bureaucracy go down. But from an economic perspective, and will we still have the momentum and the growth momentum to kind of get us out of the quagmire that we really are? It has really been siloed. AI has done well, crypto has done well, but if you broaden out beyond those two things, that we don't have a massive, broad support, strong economy like we need.
Well, so you mentioned some of the markets offshore. You mentioned Europe. You mentioned Asia, particularly China. Valuations, obviously, in those jurisdictions are much below what we're experiencing now in the U.S.
True.
Right? Would you be inclined to put some money to work in either Europe or Asia?
If I had a long-term excess capital play that I knew I wouldn't need a return for 60 months, if we had a major pullback, absolutely. If you're looking for a long-term growth trajectory that you don't need a return in the next 60 months, yes. But if you're looking at the next 60 months and thinking that, wow, I'm going to buy cheap and get a turnaround in 2 to 3 years, I think that, again, there is major global economic situations that are underpinning foundations that we've had for 50 years. And so that is going to take its time.
So I'm curious as to whether your defensiveness is pushing you more into the fixed income market now.
Well, that is such a great question. I'm so glad you asked it because honestly, the bond market is really kind of forecasting and really a red flagging to us that, hey, we are seeing more risk than the market is acknowledging. And the fact that Powell, again, the reason that the Fed came out at the last FOMC meeting and really pared down expectations is because Powell has been almost preempted in his last two raises that basically he cut and the market took it right back up to not only the pre-cut level, but higher.
Right.
And that's what happened again in the last FOMC meeting. He cuts again 25 bips and we're back to 4.5.
Right.
This is crazy. So I think fixed income, I don't want to say it's going to be another 2022 year, but we are going to see that what the Fed and central banks are doing globally is not aligning with what the market is pricing us from a risk perspective.
What are you hearing from clients these days? What's their biggest concern?
I think that they are so double-minded, and this double-minded in the sense that they hear the AI, they hear the crypto, they hear all of these wonderful new technologies that really are going to have decades and decades of a long growth trajectory and runway, but yet they do know that things just aren't exactly right. They do still know that prices are still sticky. Inflation is 2.7 CPI now. It's going up. We expect the unemployment rate, according to policymakers, in 2025 to jump to 4.3%. So you're seeing these indicators that there are fundamental underlying problems, but yet everything seems so positive because, again, it's like a irrational exuberance, Alan Greenspan, to mention like the dot-com era, again, only in the AI crypto space. So it feels like a dichotomy of two different messages.
If you had to put a number on what you expect the total return for the S&P 500 to be in 2025, what is that number?
Well, I mean, I think if we have another year like 2024, we could easily see, growth is slowing down globally. But I think if we're going to have a repeat of this year and exactly what happened this year, as far as how the growth went, I think we could still see anywhere from a 7 to 12% growth rate. Literally, not necessarily broad spectrum, the entire market, but the sectors, right? But again, though, Doug, if we start to see the geopolitical and the economic weaknesses of Asia and Europe come to our shores, then we could have a loss year. And that's the issue that we're not exactly sure which way it's going to go.
Rebecca, thank you so much for being with us. Happy New Year to you.
Thank you. You as well.
Thank you. Rebecca Walser is president at Walser Wealth Management, joining us here on the Daybreak Asia podcast.